Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. This week on the podcast, it's time for one of my regular chats with Andrew McHattie, the editor of the Investment Trust newsletter. We last spoke just over a month ago, Andrew, and, well, it's been quite a lively time, shall we say. That was before Liberation Day, the announcement by Donald Trump of this whole wide range of reciprocal tariffs, which have been temporarily paused in some cases, but not in others, and has further triggered a kind of market, well, I don't know, we'll call it convulsion. It wouldn't be a total exaggeration, I would say. Been a lot of volatility. And the latest fund management survey done by Bank of America shows that professional investors, at least, have gone into a bit of a defensive mode. They're worried about a recession and so on. So what do you make of it all? We knew that Donald Trump's tariff program was going to shake things up a bit, but it's been a little bit more violent than that, I think it's fair to say. Would you agree?
Well, I would definitely agree with that, Jonathan, that's for sure. And I'm going to be wary of saying anything too definitive on here because, of course, things are changing quite rapidly. And we have jumped into this really extraordinary period for the US economy and for markets. And I think it's tremendously difficult to forecast what happens next when governance and policy appears to be created seemingly on a whim. It depends on how the great leader wakes up that morning. But it does feel to me as though some irreversible damage has been done here to the US economy, whether or not the tariffs come back in full force or whether eventually they fade away a bit. This does remind me very much of Brexit, actually, and that this is a real turning point for the US. It could really mark the end of US exceptionalism, I think. And I think it's going to cast a long shadow. Because when I think we see the damage to the US economy, inevitably that's occurred in terms of the confidence of investors and the confidence of firms and of consumers, that's going to create a long shadow and the data is going to be worsening for quite some time. So we're going to see a long tail here, I think, of slowly deteriorating data on the US economy. And therefore, I think it's entirely justified that institutional investors have gone a little bit defensive.
Yes, I mean, I guess one could say, and some people I see are saying, that normally when the consensus opinion moves so completely and universally to one extreme, that means that can create opportunities. And sometimes that's been true in the past, and sometimes it's not been true. But there would need to be some sort of trigger for people to change their minds about the fact that this, as you say, the whole thing is up in the air, essentially. The post-war history of US leadership and trust in it by other countries and other investors is certainly up for grabs. Since that day, the Investment Trust Index is down around 3.5%, I think, something like that. A majority of investment trusts have been affected by the downdraft from these announcements. But as you say, if you look at the trusts that have been most affected, it's the ones who are in the eye of the tariff storm. So China, obviously, and Vietnam, perhaps the second most directly affected. And, of course, the tech stocks in the US and US-focused trusts in particular. But I guess the point is here, there's no real escape in the sense that the American market has been such a dominant part of investor returns for quite a long time that it's inevitable that there is going to be some downdraft as these changes and the kind of uncertainty evolves over time.
I think that's right. There's really been no place to hide. I was watching the investment trust sector very closely as always, and it seemed to me that it reacted in a very rational way, that the individual price movements were much as you'd expect, exactly those sectors you've mentioned falling most vigorously. But it was logical as well for everything else to fall, because even if your underlying holdings are not affected too directly by tariffs, and there have been quite a lot of releases by investment companies saying that they've been through their portfolios and that not many of their companies are directly impacted. Even if that's true, nearly every investment company has an inverse correlation to inflation and interest rates. And I think the outlook for those key factors have both deteriorated very considerably. So it's those second order effects really that drag all prices lower. So I was quite keen, actually, to look for some price anomalies to see if there was any good trading possibilities. But I think the market's actually behaved very rationally so far.
I think on the whole that's true. And it's also been encouraging to see, I think, that some of the defensive vehicles that are meant to protect you in times of volatility, they've also, to some extent, delivered on their promise. So we've seen BH Macro and even Rougher have actually performed, who've had a pretty torrid time by their standards and against their criteria for success. They've actually provided you some protection in the storm. They're up mildly, I think, over the period. So I guess, as you say, the sector overall has been performing pretty much as you'd expect. I have to mention here, I promise we won't go to talk about it, but the best performing trusts have, of course, been your friends in the battery storage segment. And indeed, renewables generally have actually done a little bit better, perhaps, than you might expect over this period.
Yes, that's right, actually. And I think the renewables sector, of course, offers very high dividend yields. And I think many investors are now skewing towards those because in a market where you believe you can't forecast it, effectively, if the future's 50-50, it doesn't look all that attractive. But if you're going into a trust that pays you a good dividend yield, you're at least fairly sure of getting at least some return on your money. So that makes sense to me. And I think elsewhere there are special situations, and undoubtedly the battery storage sector falls into that bucket. But again, I think it's logical and rational to maybe focus a bit more on those special situations where you believe there's a good chance of value realization, maybe because of large existing discounts. Again, if you're uncertain about the direction of markets more generally, that's a way of trying to skew some returns in your favour. So again, I think it's logical behaviour in the markets here.
I should say that the renewables generally have not performed that well since the start of the year, but just in the last few weeks they've done a little bit better perhaps than some others. But I mean, the backgloss to that too is not particularly promising in the sense that if it's true, as the chairman of the Federal Reserve, Jay Powell, was suggesting consistently over the last few weeks, that effectively the Trump program is kind of negative for inflation and for growth, that must in turn have an impact on power prices and so on. So it's not going to be an ideal environment where you've got higher than previously expected interest rates and perhaps further economic decline. So we're certainly not out of the woods yet, as you say. Well, let's talk about some of the news that we've had anyway. Meanwhile, in the investment trust sector, there's been some more consolidation, takeover activity. We're finally pretty close to the end of the saga involving urban logistics, ticker SHED. Perhaps you could bring us up to date on that one.
This was always going to be one we were going to be talking about because it had been targeted by Achilles Investment Company, the new vulture fund that was launched by Harwood. They had requisitioned an EGM here to remove the directors, but actually they've now withdrawn that because there's been a further development, which is an intended bid from London Metric Property. The bid hasn't actually happened yet, but they've said they're going to. And this makes a lot of sense to me. London Metric Property is a big FTSE 100 company with a 6 billion portfolio that's already very skewed towards logistics. And it's already been a consolidator in the sector. It previously bought LXI REIT. And they've now said that they would like to merge with Urban Logistics REIT. And the offer is a mix of shares and cash. It's roughly 2/3 in London Metric shares and a third in cash. And you're also going to be eligible for the next dividend on Urban Logistics REIT. So if you add that lot together, the bid is valuing SHED at about 152.5 pence. And the shares are about 143 in the market. And I think that compares quite reasonably against the NAV, which is about 158, 159 pence. So just a small discount here. So my feeling is that that bid is going to be good enough if it goes through. And that means that this is another REIT disappearing from the sector. And we talked about this, haven't we? How the property sector is getting smaller and smaller in our investment trust world.
Indeed it is, yeah. And whatever the perceived advantages were of being a listed investment trust as opposed to being a REIT on the main market, they have effectively been sort of abandoned, if you like. No one seems to believe that's the best model for them. So this is the end of the road of this one, do you think? Is anybody else going to come out of the woodwork and maybe make an alternative offer here?
Well, you never know. And that's what's happened in the battery sector with another bid coming for Harmony Energy. So that's had 3 now. But I don't really see it happening with urban logistics because it's quite big. It's about £600 million. And I don't think there are many buyers for a portfolio of that size. And it also just strikes me that this is pretty much a done deal. I think it suits all parties. And it's a good price, really. It was quite close to the NAV. And if you look at the other deals that have been done in the sector, they've generally been done at a bit of a discount. So I'd be quite surprised if somebody else came in, but you never know.
Let's move on and talk about another property trust then. Let's talk about Life Science REIT, ticker Labs. This is a more recently launched trust that does pretty much what it says on the tin. It's in the business of developing laboratory space for life science companies. What's been the development there this week?
So this is an interesting special situation. I think this is one that you could focus on if you're looking for opportunities. The trust here said in mid-March that it was going to launch a strategic review that could result in the sale of its portfolio or a managed wind down. And that seems pretty likely to me because it's been a disappointment here. Effectively, this was one of those trusts launched during the period of low interest rates, and it's struggled a bit since interest rates went up, so funding costs have risen. And actually, it's found that although it has been letting its properties at a reasonable pace, that it hasn't done so as quickly as it thought it was going to. So the revenue has not been flowing in as rapidly. So generally, it's been a disappointment in spite of actually, I think, being quite a bright idea in the first place. And it's too small. It's about 155 million of market cap. So I think it's probably going to disappear. So this week it had its results. It's just confirmed its latest net tangible asset value per share of 74.4 pence. And with the shares around 44, there's a discount there of about 40%. So if you do believe that this trust is likely to disappear and to realise value in some way, that 40% discount's giving you quite a cushion. And it may take several months, of course, for this to work out. But we'll have to see whether there are any willing buyers of these assets, which are slightly unusual. It's not mainstream to be buying laboratory space. But if there are some buyers about here, I think there could be a decent uplift in the shares to come.
Okay, so let's move on then and talk more generally about the consolidation process. I mean, effectively, pretty much every week, every month, we're hearing ways in which the boards of investment trusts are reacting to the pressure of wider discounts. And in particular, we've heard a lot, obviously, from the activist investor Saba Capital. This week, we've actually seen Saba Capital strike a deal with one of the 7 trusts that was the focus of its Big Bang approach just before Christmas. And that one is European Smaller Companies Trust. After a lot of negotiations, they have come to a proposed agreement. Perhaps you can tell us what that agreement involves, and we can go on to talk about what the implications of that might be for some other trusts in Saba's sites.
Well, we've been wondering actually what was going to happen next here, because although, of course, over the last couple of weeks, we've been focusing on another important American influencing our markets, Boas Weinstein hasn't gone away, and Saba are still an important player in this sector. And they have these stakes in these investment trusts that they're clearly not going to be able to exit in the way they originally intended. So some alternative has to be found. And European Smaller Companies Trust has come up with a solution here. It'll be interesting to see if this does create some kind of platform for others to follow. I don't know if it's a template or not, but what they're suggesting is a tender offer for up to 42.5% of their shares. And at the same time, they've negotiated a 3-year standstill agreement with Saba Capital. So let me explain what that is. So Saba owns 29.3% of the shares, so it's a really big player here. The standstill agreement means that it won't call any more EGMs, it won't vote for the removal of directors, and also it says it will opt to take out its shares in the tender offer, but not by receiving cash. It's going to do it by taking what's called an in specie option. And what that means is that rather than the fund manager selling the shares and giving the cash to Saba, it's just going to give Saba a slice of its portfolio. So it's then up to Saba to sell the stock. So that's quite an unusual approach, and that's only available to institutional investors in this deal. Because it's very important to remember, of course, that you have to offer the same exit to all shareholders. You can't treat Saba as a special case. So the standstill agreement is one thing, but the tender offer is available to all shareholders. And that's very interesting because we don't know to what extent other shareholders are going to want to come out as well, or whether, in fact, they'll just be happy to let Saba leave so they can return to the happy status quo that they had before. So it's quite an important test case, this one, to see if it does create a good outcome.
Yes, and I remember talking to the chairman of one of the trusts targeted by Saba, and he was talking about the difficult kind of calculations that boards have to make when they come to this kind of discussion with an active investor like Saba Capital, who clearly now, at least not what they originally wanted, but now they seem to be doing just a typical activist program where they want to get paid out basically from their investment and benefit from it if they actually made any money from it. But it's interesting you say you're doing it in specie. But the calculation the board has to make is complicated by the fact, what size of tender do you offer? You'd be concerned on the one hand about reducing the size of the trust to an uneconomic level, if you want to continue, that is, and the shareholders want you to continue. But the shareholders themselves, the institutional ones, have to make a calculation whether to subscribe to the tender offer, and if so, by how much, and to think about what might happen after the tender is complete and Saba, in this case, has gone away, or at least has come off the share register. It's quite a complicated calculation, isn't it? Because, the impulse of institutional investors is, well, if there is a tender offer and the share price might weaken afterwards, and I don't quite know how much I'm going to get in the tender, you might actually then decide, well, I'm going to put in by more than I want, and then expecting to be scaled back, in which case then you could end up with the company shrinking more than they actually want. What I'm saying is I think 42.5% is presumably a fairly carefully calculated figure that's trying to meet all these different objectives. Do you have any idea how this might go? What kind of proportion of the share register would actually take some money off the table here?
Well, I can only imagine how many spreadsheet models were used to come up with that figure. And I don't know what the parameters were. And I suppose it could have been anywhere between a 30% tender and maybe a 70 or 80% tender, because actually this is a sizable trust. The current market cap is about £715 million. So that tender is going to reduce it to something like 400 million, which is still a reasonable size. And that's clearly an important number that will differ for different trusts, won't it? But I don't know here, because on the one hand, it's logical for everybody to take up the tender. If you just have regard for your own shareholding and not for the wider trust, then coming out at a figure very close to NAV, less costs, is going to be better than you holding the shares at a 6.1 discount in the market. And you think, well, I can come out and I can always buy them again if I want to. But of course, the trust might disappear, so you might not be able to. So I think it's a really difficult calculation. My worry is that actually during this difficult time in markets when people are thinking about maybe taking some money off the table, this could be a badly timed tender. It could be very considerably oversubscribed, in which case Saba is not able to come out to the extent that perhaps you'd like, and you lose a lot of shareholders.
I think that's exactly the point, isn't it? That's the risk of these things, that you might lose the whole thing, even though a number of shareholders would actually like it to continue in some format. But they also have to account for their profit or loss on the transaction. So it will be very interesting to see how this does play out and whether it is indeed a template, as you say, for other of the trusts that have been targeted. I think it is fair to say, as you pointed out, that this is one of the larger trusts, the 7 that Saba targeted before Christmas for their original Big Bang approach. And so therefore it may not be a read across to some of the others. So perhaps we should just talk a little bit about what's happened to the shares of these trusts. We assume that Saba Capital itself will have hedged its exposure to the market, but that's not something that most investors will have done, I don't think. And we've seen quite significant share price movements across those 7 trusts, I think. Some of them have done better than others, but they've all been affected, of course, by what's been happening in the wider world. So, something like Herald, which easily saw off the original Saba proposal, they're now back trading on a 13% discount, and the shares are down around 11% over the last month. So shareholders who voted to carry on with Herald might be suffering a little bit of holders' remorse, if I can put it that way.
Well, they might, although, again, I think so many holders in Herald were truly invested with a long-term mindset that they probably don't even recognise that that's happened. They probably haven't even looked at their shares. So I don't know. Again, it's very hard to say exactly how different shareholders are going to react. But there is this risk, isn't there, that if you turn away the money that's on the table, then you find that your trusts go back to a discount. And that's clearly very likely to happen. But it does all hinge on whether you just want to take the cash and run, which I think was what Bert Weinstein was relying on. He was hoping that people were just very nakedly capitalist about it and would take the jam today. But I'm not sure that that's how all investment trust investors think.
I'm sure it's not. Indeed, it would be very depressing if that was the case. I think that'd be fair to say, if there were no investors who actually value the long-term opportunities that this is creating. So if we look across those seven, I mean, just to the top of head here, we know that two of them, Keystone Positive Change and Henderson Opportunities Trust, are effectively going to disappear. That still leaves quite a significant number in which we, as far as we know, Saba still has significant stakes. So this is going to come out in dribs and drabs, you'd imagine, over the next few weeks and months as Saba tries to negotiate. I think all the trusts involved have said they're going to try and negotiate with Saba and come to some sort of agreement. So that's something to keep an eye on as we go through the summer, I guess.
Yes, and it's not just those seven where he targeted them with the EGMs, because there's a whole number of trusts below that as well that also have Saba on their registers. So we could see quite a few of these. And if there's a bit of shrinkage of the sector as a result, then that's, I think, just something we have to suffer. And it would be nice to see some kind of resolution to see Saba reducing these stakes. And perhaps it can feel justified. From what I've read, I think Saba is quite pleased that it counts this as a corporate action, that it's triggered and it's getting a decent result. And as you rightly said before, Jonathan, I think Saba now is behaving much more like a traditional arbitrageur, where they come in, take their stake and try to elicit some action that means they can come out with a profit.
And of course, it's fair to say, looking at Saba's own performance, that we talked before about it may be under some pressure itself. The performance of its main arbitrage fund has not been immune from the market movements either. So there will be some pressure on them to try and realise their way out of some of these holdings at some point. They're down around 5%, I think, year to date, their main fund. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favourite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Let's talk also then about other trusts that have been in the news. What about Abrdn Diversified Income and Growth, ticker ADIG? There's been some news out of that one. This is a trust that has already been through various iterations in its life, none of them particularly successful. And we know that this one is on the way out as well. We're not going to see that for much longer. But what's the news from that quarter?
Slightly disappointing news here, because the trust has been in wind down mode for some time, but effectively it's quite difficult to wind it down. It has lots of assets that are tricky to sell. Effectively, this was a fund of funds, and it has quite a lot of privately held funds with no immediate exit. So the trust originally said it could take until 2033 to actually realise all of the assets. And that didn't really make sense for investment trust investors who wanted the liquidity. So I think quite reasonably they thought, well, we'll see if we can sell the entire portfolio. And they told the market before that they were in early stage negotiations to do that. But they've now come back with an update saying that actually that didn't work out because the sale was not going to be at an attractive price. And they think they can realise a greater value by selling their assets in the secondary market, effectively a piecemeal approach. So that's what they're going to do, which is in some ways a middle path here. So they're not going to hang on to the assets until the very end, but they're not selling them as one big block. And in the meantime, I think there's quite a lot of latent value here. The shares are 43.5p. The NAV is about 68.5. So that's a discount of about 36%. And undoubtedly, when the assets are sold in the secondary market, they'll be sold at a significant discount to the asset value. But I think there's probably going to be a bit of extra value here. Unfortunately, it's not going to arrive immediately, so that's the disappointing part. But probably if you're a shareholder, it's best off just to sit tight and be patient here.
I guess there's a general point here about the issue. If you do move into private assets and illiquid ones at that, then it can take an awful long time. And you could say you can sit tight and wait for it, but you, of course, got no certainty over when that's going to happen and how long it's going to take. So that is a bit of a disincentive for some people. Let's move on and talk about another trust that I know is of interest to you and has been the subject of more consolidation attempts, and that is Fidelity Japanese Values. This is one of a number of trusts that Fidelity run, but has been one of the, I think, less successful in contrast to most of the others have been very good performers over time. And we had here, there was a kind of merger approach from AVI Japan Opportunity Trust, which is also a kind of activist vehicle. What's the latest from there? I think the board of Fidelity Japan have now responded to that in more detail. What have they been saying about the future of that particular trust?
Yep, we've had a new update here, and it's no surprise at all to me that this trust has become mired in this new corporate activity, because I suggested in my newsletter earlier in the year that this was quite likely to be subject to some kind of corporate action because it really hasn't done well. Its 2024 results were really poor. It's changing its manager. The prior manager is retiring. It just seemed like a good time to make a change. Hence the merger approach from AVI Japan, which seemed actually reasonably sensible, but it's not necessarily the only one on the table. And what the trust has now said is that whilst it expects to fail its forthcoming continuation vote, it's asking shareholders to vote for continuation in order to give it time to conduct a full, formal strategic review of the options. And that indicates to me that it feels there could be other possibilities on the table here. So there could be a bit of a fight for these assets to come.
Yes, it's interesting, though, that there was a basic timetable laid down in the continuation vote as reflected in the articles, but they are asking for more time. And do you think that shareholders will be happy with that, though? I mean, they'll have to make quite a persuasive case that extra time will produce some more material result, would you not think?
I suppose this is another Jam Today example, isn't it? Yes, I mean, it's quite hard to say. I would have thought in general that most investors would feel it was worthwhile giving the board this time because you do want to maximise your outcome here. And again, perhaps during this time of turbulence, actually conducting a merger approach right now it's going to be slightly tricky. And so, yes, I can see both sides of the argument, but nevertheless, we'll have to see how it plays out. But it does make sense to me that you would vote for it to continue because otherwise you're closing the door on some potential opportunities that could give you a better outcome. And AVI Japan Global is a decent player in the sector, but there are others as well that have very good track records and perhaps will give you a closer approximation of the approach you had with Fidelity Japan.
Yes, I think that's fair. It's a very different strategy that AJOT is pursuing, very different to what Fidelity Japan was trying to do. Which is interesting, though, just looking at the kind of performance record of this one. The shares hit an all-time high of around 250p back in the end of 2021. But then since the sell-off at the start of 22, they basically traded sideways, and they're still around 165p. They just haven't got their mojo back, despite having, up to that point, a pretty good track record. So it's interesting. They can't presumably just blame style factors or whatever else it is. This has clearly been a failure of strategy as well as implementation, I guess you'd have to say.
I think that's right, because the trust does have a growth bias, and it's, I think, found that its holdings in small and mid caps have been a headwind. But that's true of some other trusts in the sector that have indeed picked up. So, no, it seemed there's more to it than just the style factor. And at the trust as well, it's fairly small. It's about £200 million of assets. So I think it's just run out of time here. And investors will be patient to some degree with style factors, won't they? But I think in this case, the underperformance has continued for just too long.
So there's also been other tenders being announced or considered across the sector as boards react to the current environment, and there's a couple more we can talk about. One of those is Saba Capital Financials. What are they proposing by way of a tender offer for their shareholders, and what's the background to that one?
So the background is different here because, of course, many tender offers are coming about as a result of investors being unhappy or there being some issue with the trust that causes this issue, such as an arbitrageur. But in the case of Polar Capital Global Financials, this was all planned. So this was a trust that began its life with a limited life, and that was always the idea. And Polar Capital's done this with a couple of its investment trusts. So this is a tender offer that was always in the books for this year. There's one planned for this year and then another one in 2030. And it's a 100% tender offer, so everyone can come out if they'd like to. And this is going to happen in June. And it's been no surprise, really, that the Trust has decided to do a bit of housekeeping first to try to make it as attractive as possible just before people make this decision. So the board has trimmed the management fee, and they've decided to also engage with an enhanced dividend policy where they're going to pay out 4% a year. I'm not keen on that generally, but it's a popular policy at the present time. So again, I think they're making sure that they're appealing to their investor base. So here you're going to have the opportunity anyway to exit at NAV, less cost, which is going to be, I think, less than 1%. So it's a real popularity test. We'll have to see how many investors want to exit. And I think it's probably not going to be all that many because this trust has been really good. It's done very well, actually, from its financial holdings. And I looked broadly across the entire investment trust sector at its 5-year track record. And this trust is ranked 16th out of over 240 trusts over that period in NAV terms. That's interesting. That's better than Polar Capital Technology. So it's really been quite an impressive trust. It's done well for holders. So I can see why they would like to continue. The other factor here is that I think that performance record is reflected in its fairly narrow discount to NAV, which is 2.7%. So you're not gaining that much in monetary terms by deciding to leave. Undoubtedly, there'll be some people who want to come out, but I don't expect a big take-up on this tender.
Yes, it has been successful. And it's interesting that that strategy of having a limited life, they're one of the few trusts that actually have that approach. But it could actually work to their advantage, as you said. It's an interesting approach, and it certainly offers shareholders the kind of certainty that they will have an exit opportunity at some point, almost certainly. And if they're successful, though, you would also hope that that means that they can carry on, as you say. And I'm sure you're right that they will be able to do so. One other trust you mentioned to me as being of interest this week, and I'm interested to know why you think that, and that is Henderson Far East Income. Tell us more about this one and what struck you about this particular trust. Why are you following it in the way you have?
I can see why you're puzzled because it's maybe not a trust you'd immediately alight upon. But for me, it's such an interesting one because I think it's a really poor performer. And yet it's trading on a premium rating. And there aren't that many trusts on premium ratings, so it does stand out. And this trust is trading at a 4.7% premium to net asset value. And I think the reason for that is very obvious, that it has a tremendously high headline yield, actually in excess of 12% now. And that is the highest dividend yield you can get from any equity investment trust. But the point I'd like to make is that that is achieved very much at the cost of overall performance. And if you're looking at capital and income returns here, it's been really poor, this trust. And again, over 5 years, this trust is ranked 218th out of 242 trusts. So it's not done well. It's bottom of its peer group over 1 year, 3 years and 5 years. So it's not logical at all to me that it should sustain this premium rating. In its last 6 months results, its NAV total return was 2.4%, and that compares with the two indices it follows, which were up by 4.6% and 5.7% respectively. There are other options in this sector, and I think investors are better served actually by looking at total return here and maybe shifting into another trust.
Yes, I did look up the numbers actually on this one because you'd mentioned it. And yeah, the annualized total return over 10 years is under 2%. You are getting income, but effectively you're not really making money over the period. You're getting income today, but that's about it, as you say. And that is a pretty poor record for a trust over that long period, that's for sure. Well, that'll be interesting to see. What did they have to say about their results in their latest announcement?
They do recognise the fact that they've underperformed, but again, they tend to point towards style factors and the fact that the kind of income stocks that they're buying are not the ones that the market is demanding. But they've been saying very much the same thing for as long as I can remember. And I just don't think that's an excuse that washes with me. Now, again, the board is conscious of this, and they have tried to adapt the style somewhat so that they're shifting the trust a little bit towards more growth assets. But if you're trying to maintain the yield at that level, there's not very much you can do, because you've got to be buying those high income assets. And so I don't really see this improving. I don't see it changing. And if you're prepared to give up a bit of that yield, or quite a lot of that yield, you can buy actually very good trusts that operate in the same sector, something like Schroeder Oriental Income, where you're getting a much, much better performance historically. You're still getting a yield of about 4.7%, so it's nothing like the 12, but it's not that bad. But you're able to buy on a discount, and hopefully your total return will be much better.
So finally, Andrew, I'd like to ask you about another trust which doesn't get a lot of publicity, I don't think, over here, but is quite interesting given what's going on. And that is Third Point Offshore Investors, which is a well-known US hedge fund managed by Dan Lowe, where the board has been saying for a while that they have been undertaking a strategic review for some time. The trust does trade at a significant discount. But the outcome of that strategic review seems to be continued to be put back. They're now talking about May, having originally, I think, talked about earlier this year. But they have put out some results. So I wonder if you could tell us what you make of that one and what you think is actually going on there.
This is another trust that's on my radar, and it's on my list of special situations. And I do think it's quite interesting, this one. So it's a US hedge fund, and it is exposed to some degree to US stocks. In the market decline, it suffered about half of the market decline. So it is somewhat exposed, and it hasn't done very well this year. Its assets are down about 11% in the year to date, and it hasn't covered itself in glory. But I think if you're a holder, you really are anticipating this news, which has been delayed. So originally the trust was due to announce their conclusions to a strategic review by the end of December. And then it said that because it was really focusing on one particular option that it was interested in, it was going to tell you the news in early April. And then in early April, it said, well, we're still working on that, so it'll be May. And this reminds me a little bit, actually, of Harmony Energy that did this as well and shoved the news backwards. And I think this is not the trust tinkering with some small aspect, because it wouldn't take that long. So there could be some fairly major news here. And I think the trust has been annoyed for some time that it's trading on a discount, and that discount is still 20% now. And so my feeling is that you could be due for some kind of exit at NAV here. Already last year, the trust did a tender offer for 25% of its shares at NAV. And my feeling is that that's probably the least you can expect when the news finally comes out. I think it probably will be announced in May. Hopefully it won't get shoved backwards again. So I don't know what's coming, but my feeling is it should be major news, and it could well be a complete exit opportunity, in which case a 20% discount currently looks quite attractive.
Yes, it does. I mean, it is interesting what they've been saying. In December last year, they said that they have a strategy committee which is tasked with doing the strategic review, and it identified a compelling strategic option, and that it would use the first quarter of this year to work expeditiously with its advisors to fully diligence this option, lots of adverbs here, probably not necessary, and present its details, findings and recommendations to the board. So it's kind of like a tease in a way, isn't it? They're trying to really get investors excited about this. And the danger, I guess, is that you raise expectations too high ahead of the actual outcome, whatever that will be, and then you're going to get some disappointment at the reaction. And if so, you would also expect, though, that if this was such a compelling opportunity, that the discount might have come in a little bit in anticipation of that. But the market doesn't seem to be convinced by that. Let's put it that way.
The market doesn't seem convinced. To some degree, though, this is a trust that sails under the radar. I'm not sure that everybody's really that aware of it or that interested. It's dollar denominated. You can deal in it, okay, so you can deal it in the shares on the platforms, main platforms, but I'm sure many investors just see this as something really quite esoteric and beyond their interest. So I don't know. I think as well, it's reasonable to have some kind of discount on there, because we just don't know what's going to happen. It could turn out to be a damp squib, couldn't it? But yes, you've got to play the odds here. And my sense is that if nothing great does happen here, then that discount will probably go back to about 25%, where I think it was sitting before. But if you do get a good outcome, then you should get an exit opportunity for at least some of your money at NAV and maybe all of your money, in which case you're going to get a much bigger uplift. So my sense is that the potential uplift here is bigger than the potential downside. So the odds look reasonable, but you're still taking something of a gamble here. And maybe you don't like the underlying assets at this point, because the underlying assets do include a basket of major US blue chip stocks, and maybe that's not what you're seeking just now.
Yes, and it is fair to say I think the liquidity is pretty poor, isn't it? The average daily transactions is very small. That may also be a factor in where the share price is today. That's certainly one to watch. I think that's an interesting one to watch. So, Andrew, that brings us to the end, I think. Thank you again, as always, for your comments and insights into what's going on. We always say that the investment trust universe is never lacking in interest, and every year we come up with a new kind of challenge. Certainly for the last 2 or 3 years it's been like that. And, well, we have to, I guess, keep the faith, I think, is the motto we have to follow in this environment. I mean, the average discount is still quite wide. It went out a little bit wider, it's come back in again to around 15, 16%, but it's been out to 17 and a bit more even. So, interesting times.
Definitely interesting times, and I think keep calm and carry on investing is quite a nice mantra, but be true to yourself. So if you're a long-term investor, stick at it. If you're a short-term investor, there's plenty to look at.
Indeed there is. So that was Andrew McHattie, the editor of Investment Trust newsletter, talking to me this week. We recorded that on Thursday morning, 17th of April, and the week has been actually fairly quiet compared to what happened the week before and the immediate aftermath of the Trump Liberation Day.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.